So, hi everyone. Thanks for giving your valuable time and joining over this call. So, we at Altport Experts India, we do this market outlook every month, on a month-on-month basis. So, our agenda and our purpose to do webinars to give insights to our investor community about diverse asset classes, forecasting knowledge amongst all our investor community. So, I welcome Mr. Vikas ji, who is our promoter and founder of Altport Experts India. He has over 2 decades of experience in this industry, basically doing aifpms as a whole. So welcome Vikaji on our market outlook. Hope you are doing well. So
Yeah,
you're
thank
not.
you. Thank you,
Yeah.
Devanshu. Yeah.
So we can start, sir.
Okay, great. So first of all, wishing you, Devanshu, and all your team members and all the clients who have taken the time out from their busy schedule, wish a very, very happy Diwali. And let's get back to the subject again. So as we do this every month, we share some important data points with all of you. So my team, the entire research team, put together a couple of data points for us to be able to take out the wisdom from those data points. So I'll share that with you, and then we'll start. So for the last 4 5 months, we have been giving you data points in terms of where the economy is headed and what are we expecting from this. But this time, we'll give you exact numbers which you can correlate and understand where the economy is headed. So the subject name this time is "Don't Miss This Time." So welcome to our monthly outlook for the month of October. So a couple of points. One, we saw that positive momentum in GDP growth. I'm sure all of you got surprised to see when the first quarter number came out, it was 7.8%. The other thing is, RBI, Reserve Bank of India, has revised India's GDP growth forecast for this particular year from 6.5% to 6.8%. And what we were expecting is that because of this tariff war happening with the US, a couple of economists had this thought that this economy number, the GDP growth, may revise to downward to the tune of 6.4 or 6.3. But that number is now inching up to 6.8%. And that's only because of the strong consumption. All of you know that this year, Government of India has given a rebate to all the people who are earning up to 12 lakh rupees, technically 12.75 lakh rupees a year. They don't have to pay any taxes. And whatever money which is coming in as a saving, they are spending in the economy. So therefore, it is driving the strong consumption. The investment coming in from outside of India also in the form of FDI, and less in the form of FPI's number to the listed space. Government spending, I'll show you the data, how government spending is going up. We had a fantastic monsoon, and in fact, it was raining in Bombay yesterday as well. So it's excess of monsoon, I would say. And the biggest gift which is given by our Honorable Prime Minister is GST 2. I don't know how many of you go to market, and this time when you go to market and see the kind of sale which is happening, and I'll show you all the numbers. So next slide, global demand study. So let's look at people. What we were expecting is that because of this tariff war, our export may go down, and the import may go up, etc. But let's look at the actual number from April to August, and this is the August end data, where we saw that exports, which is put together goods and services, it reached up to USD $350 billion. And this was, by the way, up by 6.2% if you compare this with last year. So while we were expecting that the number should come down, the number actually went up. It's up by 6.2%. Now if you divide the same of this 350 between mercantile and the service export, so mercantile is up by 2.5%, and surprisingly the service export is up by 10%. So nothing got affected there. as far as US tariff is concerned. Maybe next quarter we'll get to know even more better picture. As far as import is concerned, yeah, import has also gone up significantly. So overall import is gone up by 2.5%, and only more from a service import, which has gone up by 15%. So despite so much of global challenges and these US tariff barriers that India is witnessing, India's actual export continued to grow in 2025 also. And it's absolutely driven by strong performance in electronics. There was a time when we used to import everything, right from TV to washing machine to all the electronics that we talk about. But gone are those days. Now India is working hard to ensure that we not only meet the domestic demand of these electronic items, we rather have a plan to export this. Same goes in the engineering and high value goods as well. Now, what's happening? What is working well for our economy? All of you know that as an economy, our biggest import is crude oil, you know, and what is happening is that crude oil, the rates are falling down, and to an extent, it is stable now. So, because of that, lower import bill. So, 85% of India's crude is imported because we don't have any source of sourcing the crude from the ground level. So it what it does, so it basically helps you to improve your current account deficit. So this time the number has come down to large extent. The current account deficit is maintained. Rather, it was positive last year March time. Strong rupee and lower inflation, so it is further strengthening our INR and lowering down the inflation. The food inflation, which was out of control for almost 7-8 years, has come in control now because of the crude oil rates, which has gone down. And it also further reduced the fiscal burden for the government. And therefore, the government can lower down the subsidiary cost, which is the biggest cost for government of India. And if all that happens, then RBI gets the room to ease the monetary policy and the further it cut down the interest rate. And if the interest rate goes down, if the cost of capital becomes more affordable, then you get the boost in your GDP. And this is exactly what is happening in India. And despite so much of headwinds coming from the global markets, our markets are not going down. The other important thing which RBI has done wonderful thing in the last quarter, and I would like to highlight that. And one thing is that there was a time when money has to go to dollar, has to convert into dollar, and there it has to go to other countries. Now, what is happening is the government of India recently started all the authorized dealer banks can now lend money in INR to non-residents also in country like they are all neighboring countries like Bhutan, Nepal, Sri Lanka. So they have good amount of trades with India. So there now these bankers are lending money in INR to them, and that is boosting the regional trade settlements even more faster. So 90% of India's export to the South Asia go to these countries only. I'm talking about the South Asia as a piece, and forget this US export, etc., etc. Now, overall export, which has US and South Asia, and within South Asia, 90% goes to Bhutan, Nepal, neighboring countries like Sri Lanka, etc. The other beautiful thing, there was a time when we used to have a rupee comparable with dollar, maybe, or yen, Japanese yen, or maybe a pound, the United Kingdom's pound. But things are changing now. RBI will introduce transparent reference rates for major trading partner currencies, that is Indonesia rupee, UAE dirham, to reduce the cross currency conversion. So you will have to, if you're trading, then you'll have to convert your rupee into dollar and then give money to, let's say you want to give it to UAE, then you have to again convert that into dirham. Now things will change. Now rupee is strengthening. Rupee is becoming now a global currency, and therefore you can directly convert these with these countries. Third, SRVA investments. So now there's something called special rupee Vostro account. And now that can be invested in corporate bonds and commercial papers. So for the first time, it is happening that this BRIC country investment bank, they are now issuing money in INR, and they are buying Indian corporate bonds in INR. And this bank is these banks, like, they are BRICS based banks. They fund BRICS countries: Brazil, Russia, India, China, and even South Africa. So this is the biggest change which was noticed, and we saw that money started coming in our bond markets. And couple of past initiatives that that UPI, cross-border UPI payment, all that is a history now. That's already started happening. So RBI has promoted bilateral rupee settlement, cross-border UPI payment, measure to stabilize rupee for international use. The other interesting thing, now monthly trend capital expenditure. Everybody talks about the government kharcha nahi kar raha hai, government paisa nahi dal raha, government is busy in election. Let's look at some of the numbers. Till about last year, I mean, I'm comparing this with last year. Till about August last year, the government had spent only 3 lakh crores. This time it is 4.31 lakh crores. So you see, it is almost up by more than 30%, the gap between what they had spent last year and what they spent this year. So robust front loading, the government has continued its stand of front loading capital expenditure. Extreme level of infrastructure push, strong early spending indicates ongoing emphasis on infrastructure, roads, railways. You see defense, how much the government is spending there. And momentum indicators sustained, in terms of capital expenditure. The other thing is consumer confidence survey. There was recently the survey was done where idea was to understand what consumers are thinking in the end. Overall takeaway is that most of the people, and this survey was done between August 28 to 6th of September, people felt that cautiously they are optimistic about the economy. And this was done in urban markets as well as urban and semi-urban markets both. And they feel that their income would go up, but they also feel that inflation will also go up. So prices should go up. That's the feedback which has come overall. Now let's look at some of the important parameters that we look at. For example, we look at IIP numbers, we look at PMI manufacturing numbers, we look at. So PMI manufacturing is surging at almost 18 years of high. It is at 59.1%. And when you compare this with other economies across the globe, India stands at #1 position. So our PMI manufacturing number, so anything which is more than 50 is your expanding, anything which is less than 50 is your basically contraction in the economy. Now this PMI manufacturing, which is at 59.3%, by the way, this was last time when we discussed, it was 59.1%. As you can see the data here. And this time it is 59.3%, which means that manufacturing is going at all-time high. The other thing is automobile production. So when you look at automobile production, you have two-wheeler production, three-wheeler production. All of them are growing when you compare this with last year during the same time. So this number clearly indicates that, it is continued to be robust. Production of passenger vehicle decline due to recalibration of dispatch ahead of GST reform. So some passenger vehicle, we saw that there has been some decline last month, but the pent-up demand picked up post 22nd of last month, and that number will reflect in the next month of analysis. The conventional electricity generation recovered as thermal coal production improved, and Government of India continued to focus on renewable energy big time. As I said last time, that we are the third largest renewable energy focused country across the globe in terms of production. Now let's look at some of the monthly indicators of service activity. So India's service sector sustained the growth momentum. What we were thinking is that some economists were kind of forecasting this data that if the manufacturing number go up, then service sector may go down. But that is not the case. So it's the growth momentum is maintained with service PMI recording the highest expansion since June 2010. The other thing is international air passenger traffic remained high at retail commercial level, and overall we saw good amount of sale. Auto sales, we talked about it. This time we had very strong Kharif crop. All our farmer brothers and sisters are very happy because they got average, above average monsoon this time, and a stable RBI rate, which basically enhanced the consumer purchasing power. This time the festival, it peaked out the sales expected during this Dhanteras and Deepavali, supported by improved affordability. As I said, why don't, if you want to see the growth of India, why don't you go out and speak to some of the shopkeepers in your markets nearby your residence, and they would tell you the percentage. Because this time when auto sale was done, it was recorded 134%, highest in the last decade. Maybe because of the pent up demand of GST, because the GST was cutting the, so that is one of the reasons. But I'm saying that overall, despite all that, despite this GST 20 advantage, attractive OEM offers and easy financial options encourage the new buyers, and therefore we saw upgrades. And other thing is smooth logistic and supply chain could drive India towards a record-breaking festive retail season this time. Now let's look at relationship between US Fed rates and Indian equity. It's an inverse correlation, I would say, in the short term. When the Fed raises the rates, stock indicates often corrects due to tightened liquidity and higher borrowing cost. And the positive correlation in easing cycles. So when the Fed rate, they decide to cut the rates, equity typically rebounds as liquidity improves and valuation expand. That is what we are, we've been. This is how the framework works. But 2025, what is the outlook? With market pricing up cuts ahead of per CME data that we are talking about, equities appears to be stabilizing, reflecting optimism about a soft landing rather than a hard recession. So this is what we feel, that things will improve from here. This is the correlation between domestic institutional players and foreign institutional player. As you can see that in the last 10 years, the foreign institutional players pie is going down, their share in terms of buying the equities, holding the equities, whereas the domestic numbers are going up. As you can see, from 10%, they are now about 17.8%, and what they were holding at 20%, 21% those days, FPIs, have come down to 17% now. So this clearly indicates that we don't need any more support from foreign institutional investors, and India is capable enough to manage its own liquidity and continue to grow. Let's look at the global peer. India remains the better placed in the sense that you look at the P ratio. So while China has moved from 11 to 15.8 in terms of P ratio, and when you compare this with some of the other developing economies, or maybe some of the developed countries, you will find that India is at a highest level. I would say it's, or maybe the second highest post US. Well, number one is US, which is 28.6 P, and India, which is at about MSCI India, which is at about 25.62. But India will demand the premium because India is growing at 6.5% vis-a-vis the other part of the world, which is the world is growing at 3%, US is growing at 1.9, Japan is growing at 0.7, Europe is growing at 1% year on year, and China is growing at 4.8. So China's number has also come down from 6% to 4.88%. And next year, it is expected to go down further. So when you have a graph like this, where we see that the growth is steepening down, or there is no visibility in terms of growth improving, then obviously you can't demand premium, and therefore you don't get the desirable piece. So this is the IMF projection for the next 10 year, next 1 year. Um, in terms of performance, let's look at, so when we compare MSCI India with MSCI emerging markets, so MSCI emerging market has all Brazil, India, Russia, China, all the emerging markets. Out of 10 years, you'll be surprised to notice 7 times out of 10 times, 7 times, India, MSCI India has outperformed emerging markets. So in 2024, it has outperformed, 23, it has outperformed, as you can see, 22, 21. Yeah, 2020 was a bad year. During the COVID time, suddenly we saw correction, huge correction happening in March. Otherwise, we would have hardly missed by a small margin of 2%. Otherwise, we would have beaten the emerging market there as well. 19, we were down by 9%. When the other MSCI index has done reasonably well by 21%. But other than these 3 years, as you can see, these red numbers, 2020, 2019, and 2016, India continues to outperform the MSCI emerging market as well. This is the indices performance that we talk about every time. When you look at last 1 year, obviously markets are not doing well for the last 15 months, to be very precise, and last 1 year has been very bad for all the index. Small cap index is down about 8.8%, vis-a-vis the large cap, which is about 3.5%. And so is the case with other sectorial index also. Like, look at IT has fallen the maximum by 17%, followed by FMCG, which is, the reality is down about 20%, followed by IT 17%, FMCG 14%. And that is the reason your equity portfolio is also in red during this Samvat Diwali. So I can understand the kind of feelings that all of you are going through. But in equity, one of these years can go bad. It's supposed to be a volatile. World is supposed to be volatile. World is supposed to be uncertain. And things will change. So this is the market cap to GDP. We are at about 125%, while historical number is at about 81, 82%. But nevertheless, as I said, India will continue to demand the premium. This is the FPI's inflow. I talked about it. FII's inflow has come down. They have been the net seller. Even in the month of September, they sold equities, but they were down about 2% almost, vis-a-vis the last month, which was 4%, as you can see here. So they continue to sell. So for the last 2.5, 3 years, as you can see, from January 2022, they've been selling. And they've been selling, and their overall exposure in India has come down from 21% to below 16% now for the first time. So this clearly indicates that Indian equities, I can say this proudly, that Indian equities are in the hand of Indians and not in the hand of foreign players anymore. So it's a proud moment for us that despite all that, despite FPI's taken the money to the tune of almost 2.5 lakh crores in the last 15 months, our markets are not tanking below 81, 82,000 levels of Sensex. And as I talked to you during Diwali, Nifty is at about 25,600 levels. So this clearly indicates that our markets are sustaining. Our markets markets are doing well, rather, I would say. And you will see that from this next quarter onwards, when the earnings will start coming back, you will see that overall markets also start doing well. This is just a number that everybody has during Diwali time investing in gold. I would always say that you should have some amount of exposure to gold as a diversification tool. and we advise all our clients to follow this approach. And in terms of valuations, of course, last time it was peaked out at almost 3.1 ratio. Its ratio is like gold divided by nifty, you get the ratio. That's how broadly we use that. So this current ratio is about 3.1, and last time it was peaked out in 2016 with the same ratio of 3.1. And in 2020, during the fearful situation, it peaked out at 3.8 percent. And so it's a time where gold prices have peaked out, whereas equity relatively looks to be cheaper. But I won't say that you don't buy gold because it is trading at all-time high. If you have to have a strategic allocation in gold, you continue to have it. But if it is a tactical allocation, I would suggest you to be little more cautious, because valuations are on higher side, whereas equity looks to be well placed. So you can probably think about investing in equities now, and then once the gold prices settles down, then probably you can think about adding it more in the gold. With that, I would like to conclude my session here, and thank you so much. And I would be happy, Devanshu, if you or any of our clients have any question, I would be
Yeah,
happy.
who has joined our webinar today. So, Pranitji, I am allowing you, you can see if you can talk. I've given you the permission.
Thank you, Devanshu, and thank you so much, Vikas, for giving the wonderful insights about the market. Extremely impressed with the no summary of this report. I have one question. I think many Indians have the same question. What is your recommendation on the gold and silver against equity? Is it still a good bet to stay invested uh, in the gold and silver, or what is your take?
Yeah, so our view is that you continue to be remain invested in gold and silver at this point of time, but it's certainly not a time to add up anymore, because prices have peaked out to large extent, and I've just shown you the data points that it is at all-time high now. So maybe you can hold on to the future value, future additional requirement of the gold. But if you've already invested, then be invested and continue with that.
Okay, thank you very much. Can I have one more follow-up question?
Yeah, just a
Or
second.
maybe,
You see the
yeah,
data here. So it
yes.
is like you divide the gold rate by Nifty today. So Nifty is say 25,500 levels, and there's a gold rate, whatever is the current rate that you can take out, and divide that, then you get a ratio of 3.1% now. Now, this ratio was observed in the year of 2016, and this ratio also was, I mean, in 2020 also we saw the similar situation where this was at 3.8% instead of 3.1%. But otherwise, look at the lows also. So lows generally it is between 1.8 to 1.9%. This is 2018, 19, and 22 also. So I would say that because the prices have gone up, as you can see here, I'm showing you the chart also.
Yeah,
Because prices have gone up here, don't add here, don't do any averaging here. Just be remain invested. And if you want to add more money, let the prices to settle down a bit.
sure. Thank you, Vikas ji.
Yeah. I'm happy if you have any more question for me.
Uh, so I'm also a PMS investor,
Yeah.
and I've been hearing from my financial advisor saying that the Indian market continues to look good, and then they keep saying that the value market will return. But in the last 3 years, I don't see any value market coming up. And on the contrary, you are saying that the growth for India as compared to other countries is very positive. So given this situation, I wanted to understand. So when do you think the value market will come back? Because I see large caps are not performing at all, except very few in the Nifty.
Right. No, so we'll have to really look at a couple of parameters. One is that, large cap should do well. I agree with you. But when you look at last 15 months, FPIs have been the biggest seller in the markets. And as a result of that, the markets are not going up. And when you have a situation, and there would be 1 or 2 years like this, when last year it began, from the month of September when they started selling, and the government of India took a lot of measures in terms of improving the liquidity, controlling the inflation, revising the GDP number upwards. Government spending had gone up. So a lot of things are now in our favor. So and then because of these headwinds last year, we saw that the actual earnings started going down. Now the earnings to come back at 15%. So this quarter is also gone. So you don't see major improvement. But from next quarter onwards, you will see that earnings will also start bouncing back thanks to GST to reform which Government of India took in the recent past. So with all that coming together, my sense is that from next year onwards, once you see earnings starts coming back, you will see equity markets start doing well. And if that happens, then certainly you will see these value stocks also started participating in that way.
Sure, sir. Thank you so much for giving the insight.
Thank you.
Thank you, Praneeth.
Girish wants to ask some question. Girish Purohit.
Just a moment, I'll allow him to talk. Yeah, Girishji, now you can speak. You can unmute yourself and speak.
Yeah, can you hear me?
You are audible, sir.
Yeah. Good evening. Uh, so, good evening, Vikasji. So, I'm invested in PMS from from this March in the Emerging Opportunities Fund through you, and I'm looking for maybe from next year or whenever it's possible. I'm looking for advice where I can go for AIFs, say with 1 CR. I have the other funds which are there in my earlier portfolio, which are mainly large caps, what the names of Bajaj or L&T kind of thing, which are like very old holding. And I'm invested in PMS. So how I just wanted some advice or, maybe even consulting, 1:1 on how to go about it. Like next year, because the PMS, whether to add into PMS or go for some AIF, because I want to generate, at least 3 CR or plus, in 5 to 6 years or whatever, 6 to 7 year time frame for my retirement purpose. So how do you go about that? I wanted some advice on that. Not maybe this is a lengthy discussion now, but or maybe one-on-one.
Yeah, Devanshu. So we can have
Yeah.
one-on-one.
So, sir, our RM will reach out to you, schedule a call with Vikasji, and then we will have one-on-one discussion with Vikasji and see where we can create a solution for you on the same.
Yeah. That will be good. Thanks.
Yeah. It requires a one-on-one discussion because we'll have to really see your risk appetite levels and see the existing portfolio and see what is the duplication and what is the diversification. And then based on that, we can conclude and decide what we want to do.
Yeah. Because I had a discussion with Chandanji, who is there in Pune. But, he has shared some funds also. But since I am not done this investing in this area, I'm not able to fully grasp or understand, and with my risk profile, so probably it will help if I had a
Yeah, sure. We'll get onto the call and have a detailed discussion.
Thank you.
Yeah, thank you for attending the call. Yeah,
Thank you.
thank you. Happy
So
Diwali.
sir, more people wants to speak to you.
Yeah,
We have Pramodji online. I'm allowing Pramodji to
yeah.
speak. Pramodji, you are on mute. You can unmute yourself and then speak to us. Yeah.
Even
Can you hear me?
Yeah, you are audible, sir.
Sir, it was regarding specifically for your Vijay sir only, regarding the PMS, which you are handling for diversified funds. Okay. Which will be going to be continue the same performance? Yeah, you're feeling that in duration of next 1 year or two, a little bit that same growth
Pramodji,
is
we are
not
losing
possible.
you.
I think your fund which you are handling, Vijay sir, is going to be
Your
perform the
voice is
same
cracking.
nature.
We are losing you.
Hello.
Pramodji, we are losing you. Your voice is cracking a bit.
आ रही है आवाज?
हाँ अभी आ रही है सर, प्लीज गो
Yeah.
अहेड.
I say it was regarding the question of Sir Vijay sir is handling the portfolio which is all for diversified part. Okay.
Uh-huh.
Will it going to be perform the same? Yeah, you feel in next 1 or 2 year little little growth is not possible. The same CAGR is not possible like that way. I just want to know कि मैं PMS investor हूँ और specifically अभी market में attraction है सर आपके diversify fund. Just want to confirm मतलब वो same potential रहेगा सर उसमें?
देखिए ये बोलना बहुत मुश्किल है कि similar performance है, because every fund will go through its own underperformance at one point of time. It will never happen. It will never happen that it will continue to grow all the time. Now there will be some point of time when we will see some more correction coming in the small cap space. That is the time we will see and come out of it. But at this point of time, I don't see that situation now. So at least next 6 months to 12 months, we continue to be very bullish from this Diwali to next Diwali. We don't see that kind of situation.
Okay, okay, thank you.
Thank you.
So sir, we have one more investor who wants to ask question. So I think his name is Mr. Sanjeev ji. Sanjeev ji, your mic is on. You can ask the question.
Yeah, I have a PMS in your account, in fact. Okay, through you, it was for, I think, Green Lantern. All right.
Okay.
About the portfolio, I'm just asking. So, can we think of some portfolio to be changed from our advice to the fund manager? Because some of the portfolio which what I have seen, that is, it is almost stagnant.
Okay. So here I would say that, look, sir, because we have given the power of attorney to the portfolio manager,
Yeah.
let it be his discretion. Generally, they're not okay taking suggestion from anybody and then customizing the portfolio. What we can do is perhaps we can review the portfolio and then accordingly decide what is to be done with that portfolio. If we think that portfolio is not up to mark or not performing or not likely to perform in next 6 months to 12 months time, then probably we'll take a call and see where we can customize the portfolio and take the non-discretionary portfolio where we both can build the portfolio together.
Yeah, we can have a one-on meeting to you so that we can convey that message to the fund manager, correct?
Sure.
Yeah. So again, our relationship manager will schedule one call with Vikas ji on one-on-one basis, and then we can discuss the same thing, Sanjeev ji.
Okay, thank you.
Who is your relationship manager here, Sandeep ji?
Hello?
Yeah, who is your RM here, Sanjeev ji?
Yeah, I'm here, yeah.
Okay. So with whom you are interacting at Altport?
It is Chandan.
Chandan.
Yeah.
Okay. I'll talk to Chandan and reach out to you very soon.
So I think no more questions. I think we have taken all the questions, sir. Anybody has any questions, we will wait. I see Jayesh Rawal ji has joined us. Jayesh sir, I'm allowing you to talk. If you have any questions, then feel free to ask.
Yeah, allow everyone to speak.
Jayesh ji, I have given you permission to speak if you can speak and if you have any questions. Rohanji, at the same time, Rohanji, even I have allowed you also, if you have any more questions or if you have any questions, you can ask Vikas ji. I think you met the other day, Vikas ji also. Rajesh ji, I'll allow you in a moment. Let's see if Rohanji is asking some questions. Rajesh ji, we have allowed you to talk. You can speak. Sushil ji is left. I'll allow Sushil ji also. Sushil ji, if you have any questions, even you can speak.
Am I audible? Not.
You're audible, sir.
Yeah. Good evening, Vikasji.
Yeah, good evening.
Rajesh Sharma. Basically, when we are selecting a PMS, we are keep discussing, and we have invested various through you also and through directly also. At the time of selection, we found that past performance was really good, and then afterwards it's not moving at all. How to rework on the PMS portfolio as a whole, and keep churning it after 2 years or 3 years, or what would be the right time to evaluate and move from one PMS to other?
Uh, Thank you for asking me this question. It's an interesting question. See, most of the time, what happens is that people see the past performance and invest. Now, at Altport, what we do is that we don't keep performance as only the parameter. That's one of the parameters. We also look at the kind of portfolio the portfolio is constructor manager is constructing, and we give 65-70% of the weightage to the portfolio manager, because eventually we are betting on the jockey and not on the horse. And we see to it that what kind of track record they build on the table. Now there will be 1 or 2 years like this which is going. I know how painful it is. Last 12 months or 15 months to be very precise, where markets are really not doing well, and this is the time when portfolio bleeds more than the markets. And the reason for that is that because they are concentrated in nature, and when the entire market is going down, they tend to go down more than the markets also. Sometimes it happens. But I think to answer the question, there are two ways to look at it. One, I would look at that when I give the money to the portfolio manager, unless there is a huge change on in terms of either the stated philosophy is not being followed, then I don't give time, whether it is 6 months or 1 year. I decide to move on, because and there are times when we do it, like one of the fund that I'm telling you, where the fund manager himself got changed, and we don't have confidence in the new manager when we spoke to him. So we moved on from that portfolio. But if the portfolio manager is good, boutique in nature, has good track record, maybe going through difficult time, going through a difficult time in terms of market valuations. But if the stock continues to grow, so the one of the parameters that we look at is what is the underlying growth of those stocks. And if these stocks are growing to the tune of more than 25-30%, and the PEG ratio is about 1.1, 1.2, your price to earning ratio, then we prefer to stay back with the portfolio and evaluate and see how we can align ourselves with the thought process of the fund manager.
Thank you. And just as a follow-up question to that, is it better to have a concentrated PMS portfolio, or let us have 3-4 PMSs to be of different strategy to be safer side and at a good returns? What would you suggest?
No, I would suggest this PMS is not a mutual fund investing. So if you want to go ahead with that, probably we can pick up any of the mutual funds and go ahead. These guys pick up 70-80 stocks in one portfolio. Now here, what we can do is that the way we construct the portfolio, and we would be happy to get on to you with the review and see your other PMSs and see how it can deliver better returns. But the way we construct the portfolio is we look at different styles, and these styles should complement each other. For example, we look at value style, we look at GAR, growth at a reasonable price, we look at contrarian style. So we have few contra funds that we have selected, for example, Carnelian Contra Fund or ICICI Contra Fund. They are part of our, because in 2020 we realized that contra is an important strategy. When it goes beyond the sense market's normal consensus and take the call, like they were the one who came out of IT when everybody was buying IT. So you have to contra, and then we also look at some quant based investing funds. So these are 3-4 different frameworks in which we operate and we work. So we would be happy to align your portfolio in the same fashion, so that if it can never happen that all the 4 styles will work at a time in the markets. It can never happen. One of the styles may do well and one of the styles may not do well. But eventually you will see that if net returns, the targeted IRR is getting achieved, then we should continue to stay with those funds.
So Praneet ji has one more question. I'll allow Praneet ji to speak.
Ajay ji has any more question?
No, I'm fine. I would like to discuss one-to-one upward along with my say, Samir and you to take it forward because I'm having couple of PMSs how to reshuffle it to take it. Say recently I've invested in many through you, but let me discuss with them and then we'll get connected again.
Yeah, Jaji. Me, you and Samir will have a one-on-one call. Let's understand and evaluate. And I would tell you upfront that these are the PMSs that we should hold on to it. If something needs to come out, we'll give you our opinion, honest and sincere opinion. Okay, next.
Praniji, you can unmute your mic and you can speak.
Thank you, Devanshu. So this is a very generic question again on the PMS houses. I'm just curious about to understand how these PMS houses are leveraging on the AI when it comes to delivering better returns to the clients. So you have any insights to share in this platform?
Yeah, can you hear me? Yeah, thank you for asking this question. So, yeah, unfortunately, so far our portfolio managers have not kind of applied this methodology of, or they don't have at the moment. Our ecosystem also doesn't have that kind of capabilities to follow that. And going ahead, also, I see that the chances of these portfolio managers utilizing AI power is going to be very less because this is supposed to be a very, very high conviction ideas. They're picking up based on various parameters, fundamentals, complete fundamentals, and no technical aspect, no technical analysis done there. And AI would certainly help you doing a lot of technical analysis. Of course, it does help you with fundamentals also. So maybe as the AI gets more, it becomes even more meaningful in terms of providing various data points. Maybe 6 months, 1 year, 1.5 years, 2 years down the line, it will certainly help the portfolio manager to create the universe of the high quality. Let's say they put down the parameters that I want to see 15% ROE, 15% ROC, and then put down the numbers and give me then the filters number of companies, and you end up getting say 300 names out of 7,000 companies that you have, and then create a universe around. So it will certainly help them to create that kind of universe. But when it comes to investing, they'll have to speak to promoter. They need to understand the direction of the companies. They need to understand whether the promoter, what they are speaking and the actual number getting matched with each other. They'll have to get onto the channel check, etc. So all that may require a good amount of groundwork as well. So I would say that yes, it has to be a combination of both. But as of now, they are not applying this. That's a reality.
Thank you, Vikas ji.
So we have Sushil ji who has raised the hand. I think Sushil ji is left. Sushil
Yeah,
ji, if you can unmute and please speak.
sure. Thank you. Because my question is, what are the three sectors or themes you feel would do well in next couple of years?
Okay, clearly two or three things which is emerging very fast, sir. One is that consumption, and you've already started witnessing this consumption stories are doing very well. For example, you look at last quarter, Hero Honda used to be at 4,000 levels. Today it is trading at 5,500 levels. So already these companies started doing well. So clearly consumption, we are very bullish on. So that's one of the themes. The second thing is infrastructure. While the government of India is putting a lot of efforts and giving a lot of boost to infrastructure sectors, you don't have too many infrastructure companies, by the way, directly, but there are a lot of ancillaries who are supporting this. So there we see a lot of improvement. Third is overall NBFCs, because we see that if India has to grow, then the credit line has to grow. And we see if the credit has to grow, then it will be grown by some of the NBFCs, because they are the one who is borrowing money and then in turn lending money to people at the ground. So these 2-3 themes looks to be extremely good from a portfolio construction point of view. So I repeat, one is consumption, and consumption includes auto also to some extent, where auto sales are going up and some of the auto company looks to be promising. The other thing is infrastructure. Infrastructure, because it is, I just shown you, it is down by 20% from its peak, almost 20%. This is the index. Some of the stocks are down even higher, which is 25 to 30%. So there we see that infrastructure likely to rebound, because people are now likely to buy more houses, and maybe they will be investing in road construction also through bonds, etc. So you will see a lot of improvement there in infrastructure. And third is in these NBFCs. Uh, Even the gold side, we like this Muthoot Finance, which is Chennai-based company. So they are doing well in gold. They are able to meet the requirements of the client. A lot of uh, work is happening there. So we like these two, three sectors.
Sushil, any more questions from your side?
No, I'm good. Thank you.
Anybody has any other question?
Praneeth here. Can I take next question?
Yeah,
Yeah.
yeah.
Okay, thank you. Vikas ji, this is a question about the PMS, which I already holding for the last 3 years. This is basically the IEP from ASK. Okay, so uh, I'm actually 40 years old, and I wanted to go a little aggressive. So, what is your take on this? That is number one. And then I was also told that there is a change in the management in ASK who is handling the IEP part. So, is it really a good bet to stay for some more time, or considering my age and considering the upcoming the market move? So, do you think should I switch to any other aggressive PMS?
Yeah, so what we can do is we can get on to one-on-one call and discuss in detail. But as far as change, let me just give you perspective about this IP. What you rightly said, that there is a change in the management. And earlier, the management was more focused on buying high quality and staying onto it and holding onto it. But post-COVID scenario has changed. Now, this is no more India, where earlier Indian market cap, if you look at the bifurcation of the Indian market cap, so the top 50 companies of India used to have 50% of the market cap, which is and those were the days when we had 250 to 300 lakh crores of market cap, and only these 50 company would have 50% of the market cap, and then remaining 50 company will have about 75-80% of the company. So out of the whole bunch of 6,000 stocks which were listed from I'm talking about 2000 till about 2020, you would see that 75% of the representation coming from top 100 stocks. But gone are those days now. If India has to grow, it has to grow, it has to deep dive, it has to diversify, it has to become more wider. Now, post COVID, what we are witnessing is a huge value migration, and these large, so-called large companies are losing their market share, and it is now the SMEs, the mid-sized companies, even the small companies which are in the verge of becoming large cap have started contributing, and scenario has changed now. Now, obviously, ASK, because they had their defined investment philosophy, they were supposed to stick to those follow philosophies. So I would say that nothing wrong there. They held on to those stocks. They were maintaining the quality. But now that's because of the change in the management. I interviewed George in the recent past and had a chance to read his mind. So this gentleman looks to be extremely promising in terms of delivering the returns in the hand of investors. So no denying on that. But as far as your age concern, and as far as your other plans and all that is concerned, we'll have to sit together and discuss in detail how do we go about it going ahead, sir.
Thank you, Vikas ji. I was just curious to ask one more question. Sorry for this. I see your monthly catch-up meetings like this happens between 4 to 5 o'clock. So, any possibility to change it to the later evening so that people who are working can always find some time to catch up and can have a good discussion like this.
Sure. So next time we'll see. I'll talk to my team if they can make it 5 p.m. for you, sir.
Yeah. Thank you so much. And
Thank
I
you.
also would like to compliment.
Very, very well. Yeah, yeah,
I also
yeah.
would like to compliment To be very honest, I have not signed any kind of PMS through Altport yet, but I would like to give a honest feedback because anytime when I speak to your team, especially Devanshu and others, so they're extremely responsive and they guide the clients no matter what kind of a question they have. But I must actually compliment Altport and the entire team for this, and I really appreciate this monthly catch up. And many a times I miss this, but I make sure that I attend to your recording sessions. So thank you so much, Vikas ji.
Thank you so much. See, as I said when we were interacting last time, when I laid down the foundation of this organization, one thing was very clear that, by God grace, I have made my money myself in terms of running day-to-day life, for the whole life. But idea is that how do we now help with this, Master Sati given us so much of wisdom and learnings. How can we use this and help investor like yourself to create long-term wealth? And that is what we want to achieve, sir. Therefore, all our team members have been clearly said, irrespective of our professional relationship with anybody, we will do what is good for them, irrespective of our own conflict of interest. And the more you give, the more you get. There is no denying on that. I come from similar school of thought. I remember working with Ramdev Agrawalji, and he told me once, Vikas, that first you need to learn, then you need to earn, and then you need to return. So at 45 of my age, I have decided that I would, and I have done, aapne to dekha, I've done about more than 250 portfolio managers interview. There is not even single week that we missed out doing this for our investors. And we've got about more than 10 lakh views on the YouTube there. But having said that, we want to do is that reach out to more number of investors like yourself, sir, and really help them with the real clear cut data points. And these are data points, these are things that you can get to know from tomorrow if you see any of my team member hiding anything or telling you something wrong. This is small world. So we said that one thing, we'll reach to we'll go to other side of the table, we'll become 1% of the people where the competition is less. We will be very honest, sincere, and always ready to support, irrespective of what we make out of it or not. That is a thought process which has been deployed to the team, sir. Thank you.
I think, Vikashi, we don't have any other questions from the investor community. I think we should close our meeting session now. Thank you everyone for giving your valuable time and joining over this call. Thank you, Vikashi, for giving so insightful session to all the investor community and the people who have joined with us. Thank you everyone. Have a lovely day ahead. If you have more questions, you can reach out to our platform, which is www.altportfunds.com, or you can call us at 836-858-6435. Thank you. Bye.